FHA loans have a reputation problem. Most buyers, and honestly, a lot of loan officers, treat them as an inferior option to conventional. The backup, the second choice. Today, I'm going to show you the actual math on when FHA is not the backup. It's actually the smarter choice, and it happens more often than you'd think. Quick foundation. FHA stands for Federal Housing Administration, a government agency that insures mortgages against default. FHA doesn't lend you money. Lenders like me lend the money. FHA just insures the lender in case you don't pay. That insurance is what allows lenders to offer better terms than they otherwise would. Lower down payments, lower interest rates, more flexible credit and debt-to-income ratio guidelines. That's the whole product in one sentence. A government insurance program that makes homeownership more accessible for buyers who don't fit the conventional mold. So how does FHA actually compare to conventional? 4 differences matter. First, rate. Right now, the FHA rate at my broker level is 5.625%. The conventional rate is 6.25%. That's more than 0.5% lower. On a $475K loan, that's real money. Second, debt-to-income ratio flexibility. Conventional typically caps at 45 to 50%. FHA goes to 46% on the front end, 56% on the back. That flexibility alone qualifies buyers who conventional would turn away. Third, officially, conventional has removed credit score requirements, but lender overlays still exist. In practice, you still need a 620 minimum credit score for conventional, and it gets rough below 680 as far as pricing. FHA actually goes down to 580 with 3.5% down. Fourth, down payment. Conventional is 5% for most first-time homebuyer programs. FHA is 3.5%. That difference makes more than you think as far as savings up. Quick local tip most buyers don't know. Pierce County, Tacoma, Puyallup, Gig Harbor, Lake Bay is a high-balance FHA county. The loan limit is $1,063,750. That's nearly double what it is in every surrounding county. Thurston County caps at 586.5, Kitsap at 616.4, Lewis and Mason at 541,287. So your FHA options might be dramatically different depending upon which side you land on. Quick honesty though, FHA loans above 726.5 come with a slightly higher MIP factor of 0.75% instead of 0.55%. So while Pierce County lets you go higher, that higher loan tier costs a bit more monthly. Something to know if you're out shopping at the top of the range. Now, let's talk about the biggest legitimate criticism of FHA, mortgage insurance. FHA has 2 forms of mortgage insurance. The first is UFMIP, upfront mortgage insurance premium. That's 1.75% of the loan amount charged at closing. It's financed. You don't write a check for it. $475,000 loan, that's $8,313. But it's still real money added to what you owe. Second is monthly mortgage insurance premium, MIP, typically 0.55% annually on a 3.5% down loan, paid monthly. And here's the piece that gets FHA its reputation. On a 3.5% down loan, that MIP stays for the life of the loan. It never falls off. That's the myth buster. MIP for life is a deal breaker. Here's the strategy that nobody explains. MIP for life isn't a life sentence. It's a chapter. When you build up enough equity, get to 20% down through paying down the loan and home appreciation, you can refinance out of an FHA loan into a conventional loan with no monthly MI. The FHMIP disappears the day you close the refinance. So the real question isn't, am I stuck with MIP for 30 years? The question is, how quickly can I get to 20% equity and refinance out? In our market, where home values have been climbing steadily and now a bit more stable, a lot of buyers hit that 20% equity mark in 3 to 5 years, not 30. That reframes the whole MIP for life conversation. Let me walk you through a real client story that shows why the math matters more than the reputation. I had a client, 680 credit score, had 5% saved for a down payment, looking at a $500,000 home. Solid buyer. His back-end DTI came in at 45%, which is right near the conventional cap. He came in assuming he wanted conventional because that's what people tell you to do. Conventional is better, right? So we ran both scenarios, both loans, same buyer, same house. And here's what came back. On the conventional side, 6.125%. Monthly mortgage insurance factor of 0.4%. And here's a detail nobody explains. Conventional MI actually gets more expensive as your debt to income ratio goes up and your credit score is a little bit lower. Higher risk to the lender, the higher MI cost to you. His monthly payment, principal and interest, and MI came in at $3,044. On the FHA side, 5.25% rate at the time, the upfront mortgage insurance factor of 1.75% rolled into the loan, monthly MIP of 0.5 because he was putting 5% down instead of 3.5% down. His total monthly payment came in at $2,867. Same buyer, same house, same down payment. FHA saved him $177 a month. Not because FHA is better in theory, because FHA was better for his numbers. That $177 a month isn't nothing. Over 5 years, that's more than $10,000 in cash flow that stayed in his pocket. And he got into the home with less financial strain from day one. This is what I mean about the reputation problem. If he'd gone with the better loan based on reputation, he would have paid more every month for the exact same house. The math doesn't care about reputation. So how do you know if FHA is a smarter play for your situation? Here's the framework I actually use with my clients. FHA tends to be mathematically better choice when three things are true. First, you're putting less than 10% down. Second, your credit score is 680 or below. Third, your back-end debt-to-income ratio is above 45%. If any two of those three are true, we're running the FHA math. If all three are true, FHA is almost always going to win the battle. Now, the flip side, when I steer clients away from FHA, three scenarios. First, if you're putting more than 10% down, at 10% down, FHA MIP falls off after 11 years automatically. But conventional PMI can be removed at 20% equity, which usually happens a bit faster. And with more skin in the game, conventional MI rates drop dramatically. Second, if your credit score is above 680. Better credit gets you better rates and cheaper MI on conventional. FHA doesn't tend to reward great credit the same way conventional lending does. Third, if your debt ratios are 40% or lower. When your DTI is comfortable, conventionals, cheaper MI on strong borrowers usually tend to win out. This isn't complicated, it's math. And the answer depends on your specific numbers, not on which loan has the better reputation. So, FHA isn't the inferior option. It's the smarter option for a specific and common buyer profile. If you're in that profile, or you're not sure whether you are, head to johncobainhomeloans.com. I'll run both scenarios for you side by side. No pressure, no pitch. If FHA is right for you, we'll walk through it. If something else fits better, I'll tell you that too. If this was useful, punch that subscribe button. Every Wednesday or sometime during the week, I break down something like this. Every Friday or Saturday, I recap the market. I'm John Cobain, mortgage broker, Edge Home Finance, NMLS 374881, 30 years helping Washington homeowners. See you in the next one. Have a great day.